Okay, Brent, we've got a lot happening. Maybe not so much from this week's overall economic data, but it feels like a Super Bowl weekend. It's a Super Bowl week next week. Your Chiefs are in the Super Bowl again. I'm a little bitter about that. But you also have a dollar debate Super Bowl coming up, I believe, on Tuesday. You can share some information on that. And then we've got the Super Bowl of all CPIs on Tuesday as well. So give us some feedback on those three Super Bowls and what you think each one is going to provide.
Yeah, well, I feel like I'm in a pretty good position because, my two probably favorite teams in football are the Chiefs and the 49ers. I grew up a Chiefs fan and then lived in San Francisco for a number of years and kind of by osmosis became somewhat of a 49ers fan. So, it's going to work out pretty well either way. Not sure how the Philadelphia people are going to feel about it, but, for me anyway, it should work out all right. The other thing is, I'm actually going to St. Louis this weekend. My son's in a volleyball tournament, so we have, and we have a chance to win that, so that's going to be exciting. And on the way home, I'm going through Florida, where I'm going to be part of a debate on the future of the dollar. It's going to be hosted by Zero Hedge, and I believe it's going to be posted on X/Twitter as well. And it's going to be myself, Michael Every of Rabobank, Jim Rickards, or Michael and I are going to be on the pro dollar side. And then on the other side is Bob Murphy of the Mises Institute and Jim Rickards, the multi-author of many books on the topic. So it's going to be exciting. I'm looking forward to that. And then not only that, but on Tuesday, we've got CPI, which of course is the most important CPI release in history, right? And in the meantime, markets just continue to grind higher, or at least a few stocks within the markets continue to grind higher. But they grind higher at a high enough rate that they have held the overall indexes up. The internals of the markets aren't looking super strong, but the top line does, and that's what people look at.
Yeah, so you made the tongue-in-cheek comment that this is the most important CPI ever. Let me add some color to that. We've more or less been saying that since July of 2022. So it's just kind of an ongoing running joke. But now that we're at this point of the cycle, the Fed has paused at least the last three meetings, if my memory serves me correctly. And within that, there's just been an emphasis on whether or not they're going to be cutting rates. And that all comes down to the inflation data, which is what CPI is, Consumer Price Index. Now, you've talked about amidst all of this, there was earlier in the year an anticipation of, or at least the way markets were pricing it in with Fed funds futures, the potential for 7 rate cuts. You had coined that at one of the earlier episodes at the start of the year as the Magnificent Seven, also tongue in cheek, kind of making the joke that it was just a ridiculous forecast. That quickly got pulled off the table by markets as the Fed jawboned everybody back, that they weren't in a big hurry to cut rates. Hence why now the CPI data is equally as important as it's always been, but more than ever right now, it's pertinent to whether or not the Fed is going to be pursuing rate cuts sooner than later.
Yeah, absolutely. And here's it's important to point this out is that, I kind of feel like so far this year, I've kind of been vindicated in what we have been talking about, how the markets were directionally correct, but from a magnitude standpoint, that they were misreading the Fed's intentions. And with the Fed's recent comments at the meeting and then the subsequent, Fed speak since then, I feel like that has been reinforced that, they're not going to be as quick to cut as the market was anticipating. But here's the interesting thing. So from that perspective, I feel vindicated. But here's the thing. My job, if I was an author, then I could say, hey, I said that they were going to have to change their language a little bit, and they were going to have to tell the market that they were wrong a little bit, and they've done that. And if I was a philosopher, I could interpret it one way, and if I was a professor, I could come out and say this is the way this works. But at the end of the day, I'm a money manager. I mean, that's what I'm graded on, and markets haven't really cared. So despite the fact that the Fed has sort of pushed back on the widely touted Fed pivot, markets, at least equity markets, have not really changed yet. So from my perspective, it's fine to be right, but in my business, you'd rather make money than be right. In other words, I would rather be wrong and make money than sit up here and say, look, I was right and lose money. And so the jury's still out on that and on what equities are going to do. Now, what I find interesting is that the bond market has gotten the message, at least to a certain extent. Bonds have definitely sold off since the Fed meeting last week. The dollar and currency markets have kind of gotten the message. The dollar has rallied since the meeting. Many of the currency crosses as a result have fallen. The other part, that we talked about is, it could be that nothing really changes in the U.S., but all of these ideas that the ECB is going to hike rates a lot and Japan's going to hike rates a lot and they're going to out-hawk the Fed. We pushed back on that a little bit. That's kind of turned out to be correct, because yesterday the Bank of Japan came out and said, we are not going to get into like a strong tightening phase. Even when we end negative rates, it doesn't mean we're going to hike a lot. And so the yen fell pretty hard today as a result. But I think in many, the currency markets have kind of gotten the message. The bond markets have kind of gotten the message. Gold has kind of been sideways. So gold's kind of in the middle. But equity markets have, for the most part, held up. And again, there's multiple ways to do that. Look at this, because on the one hand, we've got these other markets that are going the way we thought they would. And many individual stocks in the indexes are going the way we said and are no longer rising. But we still have this magnificent 7 or magnificent 5, however you want to define that. There's still a handful of stocks that are rising so much that they are holding the overall markets higher. And to me, and again, I didn't do a whole lot this week. I read a lot, I watched a lot, I listened a lot. Didn't do a whole lot because to me there wasn't a whole lot to do this week. It's just at this point, we've got to let the kind of the markets play out. We're already kind of positioned the way we want to be positioned, and I am just so curious to see which way this breaks. Are these handful of stocks able to stay strong enough to hold the overall markets higher until the Fed does finally cut, whether that's a month from now or 3 months from now or 5 months from now? Or are they also going to go the way of, the bonds and the equity, or the bonds and the currencies? And so, and I don't have the answer, and nobody knows. And that's what makes this such a conundrum, but it's also what makes it really fun and interesting.
Well, as you mentioned, Brent, you've got this debate coming up on Tuesday, and you described it as a conversation around what's the future of the US dollar, perhaps in the next decade or so. If you're new to Brent Johnson and many of the conversations he's had around the dollar, particularly on videos and YouTube conversations, it feels like you've been saying this thing for 10 years. And one of the points that you just made a moment ago, as far as being a money manager, is that it's more important to make money than be right. And you would happily be wrong and make money. Unfortunately, people don't necessarily structure their portfolios or approach the market that way. And I think that's one of the reasons the debate will be interesting, because some of the people on the other side have been pounding the table about, the dollar dying and what that's going to mean for markets and their favorite version of money, whether it's gold or what have you. And they've been continually wrong. Not that we need to peer into their portfolios, but I'm pretty sure they didn't hedge that opinion. Now, what's also very interesting, though, as objective as you are about the market, certainly your framework, which is the Dollar Milkshake Theory, and anyone who's not familiar with that entirely, we've got a playlist at the top of the YouTube channel called Start Here. We'll walk you through all that and get you caught up to speed. But the idea is that because of the size of the US economy, because it's the reserve currency, because it has the strongest military power, when we do have some sort of endgame or great reset or just global financial crisis, capital is going to be attracted to the US because it's the cleanest dirty shirt. It's still the safe haven. So one of the things here, as you point out, all the stuff that's going on in the market right now, hey, bonds seem to have gotten the message. Currencies have seemed to have gotten the message. But these 5 big mega players just keep going up. Do you think to some extent, maybe the dollar milkshake theory is already happening right under your nose when it comes to money moving into these big players?
Yes, I absolutely do. And this is probably, if I have a frustration, this is what it is. Because I actually believe that equities, US equities specifically, are going to go a lot higher in the years ahead. And so I think some people think I'm a perma bear because I think the dollar's going higher, but perhaps the most controversial, if that's what we want to define it as, part of the dollar milkshake theory is that I think we're going to get into a period where the dollar goes higher, gold goes higher, and U.S. equities go higher as well. And I've said that part of the reason will be that despite bad things happening, global capital will flow into the U.S. and flow in, and they will mainly flow into these big blue chip companies, and that will push them higher. And that has been happening for the last year and a half. Now, the frustration for me was that I actually, in the fall of 2022, pulled all the hedges. We actually bought calls and went long, and but I sold the calls and got out of that long only trade basically after like 3 weeks, 2.5 to 3.5 weeks. And in hindsight, and that was fine because then so that was like end of September into middle of November. So maybe we were long for a month. And then, we sold those calls and we probably even bought some more hedges. And then markets kind of fell into the end of the year, and that felt pretty good. But then markets rallied like crazy for the first part of 2023. So that didn't seem too smart. We had a pullback in Q3, which again, we did the same thing. We said on this show a couple times coming out of the September Fed meeting, we thought, or the October Fed meeting, that we thought that markets were poised for a couple week rally. So we bought that as well. But then same thing, after a couple of weeks got out of it. And then here 3 months later, equities are still running higher. So here's what I have sort of been battling internally with. And that is that I know that markets don't go up in a straight line. There will be drawdowns along the way. And sometimes they will be very severe and very scary. And so I have had to figure out, how do I navigate my belief, especially because of my framework, because I think capital is going to flow here. How do I stay true to that framework and be long equities, but also, be ready for these drawdowns should they come? And so I have been, people who have been listening to the channel know I've been overhedged for the last year. Now, it doesn't mean that we have been short the whole time, and we own a lot of equity, so we participated in the upside, but we certainly didn't have the turbo boost buying calls or pressing the metal higher. And that's been a little bit frustrating because we do think equities are going to go much higher in the years ahead. So to your point, the milkshake is kind of happening. And here's, I think the first time that I ever publicly said the word milkshake was the spring of 2018. And the first time I gave a big interview on it was on Real Vision in the summer of 2018. The first time I gave a presentation on it was in the fall of 2018. But in that very first interview, I'm pretty sure I said somewhere in there that there is no way I'm going to get all of this right. In fact, I'm pretty sure I'm going to get some of it wrong. But if I get even a little bit of it right, we have the chance to be able to see through kind of the fog of markets and make money. And that's largely been correct, because what I said in that first interview is that in the years ahead, the dollar would go higher, U.S. equities would go higher, and gold would go higher, but they would be characterized by terrifying drawdowns along the way. Now, if you go back and you look at where gold was in the summer of 2018, you look at where the Dow and the S&P was in the summer of 2018, you look where the dollar was in the summer of 2018, all three of those have gone up over that time period, right? So that has been full. And if you look at all three of those, you will see that all three of those had severe drawdowns along the way. So for the most part, the theory and the framework has been right, and it's helped me navigate these crazy markets. Now, have I gotten some things wrong along the way? I have absolutely gotten some things wrong along the way, and I will continue to. But I think overall, the framework is solid, and I think it will continue to play out. And I hope, and hope is not a strategy, but I do hope that this framework will help me not only get through and navigate what I expect to be very volatile markets, but make some money and make a lot of money, because I think we're going to have an opportunity to make a lot of money if we see it correctly and many other people don't.
Well, it's helped you participate, maybe like you said, not to the full extent with leverage and full metal to the pedal, but it certainly served you better than many people who have been vocal on the other side, at least specifically in the case of China. Do you want to talk about some of the things that you're seeing? We did touch on it an episode or two ago, but it's definitely accelerated.
Yeah, and I think this is where you got to. I'm going to repeat stuff that I say, and the reason I repeat it is there's two reasons. One, for the people who've already heard it, to hear it again, and hopefully it sinks in. And then also for any new people that have, are new to the channel and haven't heard this before, is you have to kind of train yourself to, when you analyze stuff, figure out what you think is actually going to happen, whether you want it to or not. Don't just invest in something because you want it to work. And you have to kind of be ruthlessly honest with yourself about that. Part of the reason when I kind of came up with the whole dollar going higher thesis, part of the reason that I thought very strongly that I was correct was because I hated the answer. I did not want to believe that the dollar could go higher. But that's where the evidence pushed me. And the more I studied it, the more I became convinced that was what was going to happen. And I think the reason I bring this up now is I think with regards to the United States and China, I think many people are portraying or they're letting their emotions influence their forecasts of what they think is going to happen. And many people, many really successful, really smart people who I respect, have been saying that China was going to rise at the expense of the United States and that they would become the next global hegemon or global leader, however you want to define that, and that the US had some serious problems and that they were going to pay the price for those happening. And the things that they would say is, the US dollar is going to fall, the budget deficit's going to rise, the stock market is way overvalued and it's going to suffer a huge crash. The real estate market is unstable. We had these really low rate mortgages and people bought too many homes, and that is going to fall, and that's going to lead to widespread, unemployment and all this stuff, right? And they would tout these things as inevitable, and when they would happen, that would signify the end of the glory days of the United States. Again, it's a fair forecast. I don't necessarily have a problem with the forecast, because if you just analyze the United States in isolation, it's kind of hard to come to a different answer than that. The problem is you can't advertise or you can't analyze the United States in a vacuum. The world doesn't work that way. And then also, all of these things that many people are worried about one day happening to the US to lead to its demise is happening right now, today, in China. Their stock market has crashed. I don't care how you can say, oh, it's just a correction. Okay, it has crashed. Now, whether it rebounds from here, maybe the bottom's in, maybe it's going to rally from here. But the fact is it's crashed. Their real estate market has crashed. That's a fact. Z just fired with I think his chief economic advisor and brought in somebody new. Z doesn't go around just firing people for the hell of it, right? He fired him because he wasn't happy with what's going on over there. They've tried stimulus after stimulus, and it hasn't really worked. I think Z came to power in the early 2010s, maybe 12 to 13 time frame. Since then, if you look at a number of different Chinese economic statistics, that was the peak of China, and it has been a slow grind lower, and in some cases a fast fall lower over those 10 years. The Yuan, and again, people are always talking about the fate of the dollar. What's going to happen to the dollar? Over the time period that Xi's been in power, the Yuan has lost 15 to 20% of its value versus the dollar. So if China is outmaneuvering the United States in all of these things, then why is their stock market down when the US stock market's at its all-time high? Why are they having huge problems in their real estate market when ours continues to rise? And here's the thing, people will say, yeah, well, we're doing stimulus and, we bailed out the banks and there's all this secret funding. And That's what China's doing. China's doing the same thing. So the idea that, again, and if and when the U.S. dollar falls dramatically, and if and when the U.S. stock market falls dramatically, and if and when the U.S. real estate market falls dramatically, if you will say, "See, I told you so. I told you this was going to happen, and this is really bad for the United States," then if you are really objective, you have to be saying that about China right now, because that is exactly what's happening over there. Now, again, whether that's how it ultimately plays out or not, I don't know. I think it is, but I don't know. But the point is to be ruthlessly honest with yourself and objective. And, it's hard to do it when you do the analysis yourself. But, a lot of times I will post something on Twitter and I'll take off the title, because if you give somebody the title, they will analyze it with a preconceived notion, right? There's been several times where I've taken a graph and I've flipped it upside down, or I've posted it backwards, and just to get people's attention, and you get totally different answers than if you told them what it was. And so, again, you kind of have to train yourself to be able to do this, and it's not easy, and I'm certainly not perfect at it. I've tried to get better at it, but that's what I see going on in the world right now. For all the problems that the United States has, on a relative basis, our economy looks the best. Now, that might change next week. I don't know. Maybe it will. But as of right now, the U.S. is kind of kicking on many cylinders while many other countries are really struggling.
Yeah, I'm making my own prediction here, somewhat of a spoiler alert. I have a feeling that your debate next week is going to surprise a lot of people, because you're in a lot of ways going to be on the same side as the Rickards team, in that the only differentiating part is timeline, right? And that this whole thing can span out much longer than people think.
Well, the interesting thing, John, is the four of us have been, or five of, because Adam Taggart's going to be moderating it. We've been having some emails over the last couple of days, and the funny thing is that the debate has already started. And the debate is, what is the time frame we should use for when the U.S. loses status? Because here's the thing. Anybody with even a cursory understanding of history knows that fiat currencies fail. That's just a fact. They just do. Okay? So saying that the dollar is eventually going to fail is not very valuable. I mean, it's important to understand that, but that is not in itself going to produce any alpha. The only way you produce alpha is to get the timing at least somewhat correct. And so, to me, it's not even the debate of the fate of the U.S. dollar. The fate of the U.S. dollar is, at some point, it will lose global reserve currency status. It will continue to lose value, and the U.S. will no longer be the global superpower. Now, whether that's in 2028 or 2128, I don't know. But, it will happen. But if you don't get the timing right, it doesn't really matter, right? And so I just think it's interesting that the debate that we've already started amongst ourselves is, do we say 2025? Do we say 2030? Do we say 2035, 2040? Like what's the date that we're saying this is going to happen by? So anyway, I'm actually looking forward to it. It's going to be fun.
Yeah, if we're still doing this podcast and there's a 21 something in front of the year, we're going to be plugged into machines and talking like Biden will be trailing off. You'll be like, John, back here. So I get you on the timeline thing. I think that's a lot of these people should have been held accountable to that exact point, decades ago, because they've been very wrong for a couple decades. So it'll be interesting how that goes. The other thing you pointed out is oftentimes you'll share charts, or just anybody should really look at the information with an open mind and not have this bias applied to it immediately. You've done conference presentations where you've actually argued against the dollar milkshake theory just to prove a similar point. But why don't we talk a little bit about some of the evidence that you kind of glazed over there as far as what's going on in China? Because, as people were watching you talk about that, maybe they noticed my eyes kind of wandering around on my screen, because you shared a few charts and I was just kind of looking at them. And you had this huge move in 2006, right? It's the end of the world. The US dollar is going to crash and China is going to take over. And since then, in terms of pricing these indexes in renminbi or yuan, they've gone violently sideways, but they're now starting to break those very, very multi-decade trend lines. and that's in their own currency. And so, with various slight currency devaluations, a ton of capital injection into these markets, you could argue this violently sideways is heavily manipulated. But what is now happening is it's starting to break those trend lines. And as far as US dollar and yuan relationship, like you said, over the last 15 years, the US dollar is up. So give us some feedback on some of these charts and maybe talk about the ones you find most interesting. And I'd also like to hear your thoughts on when I'm looking at the yuan in general. Right now, it's in between 7 and 7.5. This is kind of the very high end of the range. It's getting a little dicey. What do you think is the result? What are the macro knock-on effects if this blows through, $8 on the yuan to US dollar?
Well, I mean, that is chaos. That is chaos. So here is why it's important. You will often hear me say that the China has done stimulus after stimulus to try to get growth back into China, and it hasn't worked. The reason that I have said that many times over the last year or 6 months or 6 weeks or however often I bring it up is because one of the most important ratios in the entire world of macroeconomics is the US dollar yuan cross. And the reason I say that is that if the dollar is getting weaker, that is generally the world doing okay. Growth is happening, leverage is being expanded. There's not contraction, and economic growth has a chance, right? Now, if that goes the other way, and I've shown this chart several times that every time there's been either a crisis or an economic slowdown over the last 25 years, it has coincided with a rising dollar. That is 100% correlation. It's not highly correlated. It is completely correlated. It's just the way it is. And so if China continues to try to stimulate their economy and it does not work, one of the last ditch efforts that they might have to make is to devalue the currency. Now, they could do a small mini deval like they did in 2015. And if you remember in August of 2015, when they did their mini deval, I think they took it from like 625 to 650 or something like that. It wasn't even that big. It was but it caused a lot of chaos in the markets in the summer of 2015 when they did that. Now, the chaos didn't last and it ended up being okay, but it caused a lot of volatility for 2 or 3 weeks or a month or whatever it was. Now, if China has to devalue their currency, that has huge implications. If the small mini deval, from 625 to 650 caused chaos in the markets, imagine what the deval from 7.5 or 7, I think it's 720 now or something. If it goes to 8 or 9, that's chaos. Because remember, the whole point of stimulus, and this is the same whether it's the US doing it or England doing it or China doing it or Japan, providing stimulus is a way to combat deflationary pressures. So when you're providing stimulus, you're trying to create inflation. So you're trying to create inflation to combat the deflation. Well, if you do a devalue of your currency, that's not, taking out like a little pop gun and shooting at it. That's the bazooka, right? That's not even the bazooka. That's the nuclear bomb, the total deval. So if China did that, the reason they would do it is they would do that to offset the deflating real estate market. Now, the Chinese real estate market is the biggest asset class in the world. It's like 60 or 70 trillion dollars. So if they have to devalue their currency in order to bring enough inflation into China to offset that deflating real estate market, that deflation has to go somewhere. It doesn't just disappear. It disappears from China. It disappears from China because they devalue their currency, but where it disappears to is the rest of the world. And so that deflation gets sent out into the rest of the world in the form of the dollar going higher. Now, the dollar goes higher for a couple of reasons. One is because the Chinese yuan is devaluing against it. So on the other side of the coin is the dollar going higher. But not only that, but as the dollar goes higher, that creates deflation all over the rest of the world because the rest of the world has borrowed in US dollars. And so now their funding terms have gone up dramatically. So China devaluing is a huge deal. Now, I think ultimately they're going to have to do it because I don't think that they can get it under control any other way. But whether that happens this year or next year or 3 years from now, I don't know. Again, that's the timing, right? One of the other charts, though, that I sent was so not only has the currency been weakening, but the stock market in China has been weakening. I posted a couple different indexes, but essentially the stock markets in China are like 50% lower than they were 15 years ago. So I think they peaked back, before the global financial crisis, and then they had a drawdown of like 70%. And then they rallied back up and almost got back to the highs again in 2015. And then with the mini deval, then they had the market corrected, their stock market corrected like, I don't know, 40%. And as a result of their stock market coming down, that's part of the reason they did their mini deval, and that helped, push equities higher. And then equities got almost back up to their high. Maybe even they got to the high that they had been at in 2007. I think they kind of had a double top, and then COVID hit. And since COVID, the big run up was post COVID. So it rallied into COVID. It fell hard during COVID, and then with all the stimulus that the world provided after COVID, then it went back up and it retested its high from 2007. And since then, it's down like 50%, 40 to 50%. And to your point, it has broken these very long-term, like 20-year, 30-year support levels on a technical basis. And remember, this is you mentioned this is in Yuan terms. And that's in local currency terms. But the Yuan has fallen 15% against the dollar. So if we measured this in dollar terms, it's even worse. And so, this also has effects on to Hong Kong. And I think people have heard me talk about Hong Kong before, because one of the biggest trades that we have on, or one of the most asymmetric trades we have on, is we believe that the Hong Kong dollar peg is going to break. And so we have put options against the Hong Kong dollar. If you look at Hong Kong's stock market, it's down like 50% as well. And it broke. So this is in Hong Kong currency terms, but the Hong Kong currency is pegged to the US dollar. So it's basically already in US dollar terms. But it's down like 50% in US dollar terms. And it is now, last year, it broke like a 40-year or a 30-year like trend line. And now it's broken the second 30-year trend line. And so it's basically below all support at this point. And nothing seems to be working. And so again, one of the things that could help push the Hong Kong stock market higher would be a similar thing that we were talking about that could push China higher is a devalue of the yuan. They could depeg the Hong Kong dollar, and that would provide a tailwind for Hong Kong markets. But that again would send a deflationary wave to the rest of the world. So this is why this is really important. And the reason these are really important is because, again, there is so much debt, global debt in US dollars. The rest of the world owes over $30 trillion in US dollars. And they don't owe it to the United States, they owe it to each other. So if they default on it, they're losing $30 trillion, right? So, and this is why when people will tell me, we're going to have this debate on the future of the dollar, they ask me, why does it matter? If all fiat is getting debased, why does it matter if one's getting debased faster than the other? Well, if it's the euro versus the yen, or the Turkish lira versus the Indian rupee, maybe it doesn't matter that much. But when it's versus the US dollar, it's incredibly important because it is the global funding currency. And if it rises, that puts incredibly deflationary pressure in US dollar terms on the whole world. And that is why the fate of the US dollar matters, even if it's fiat versus fiat. I mentioned earlier that one of the most important ratios in global finance is the yuan dollar cross. Well, It's also the Yuan, or it's also the dollar yen cross. It's also the dollar euro cross. It's any cross with the dollar, because if a country's currency falls dramatically versus the dollar, it basically blows up that country economically. And that's why it really does matter. So, if you think that, all fiat's getting debased and you don't have to worry about it because you own gold, or, you own Bitcoin, or you have some real estate. Well, I think you got to think again, because if the whole world goes up in smoke, you're not going to be, immune just because you own some gold or some Bitcoin. And so I think it's really important to understand that.
Excellent. One of the things I want to say really quick on all of that is, everyone probably knows this, but I'm going to recommend it anyways. You can watch these videos at faster speeds. YouTube allows you to go up to 2 times speed. Maybe the first time digesting it, you're watching it at regular speed. I've gotten so used to watching content at higher speeds that it's almost difficult to listen to things at a regular speed. I mention that because some of these things, I feel like people will watch a video, and with good reason. Okay, file it away. I've already watched that. Some of these things you need to watch multiple times. And so if you ratchet up that speed a little bit and you're watching this at 2 times speed, you're getting to hear it again. There's going to be other ideas that sink in without you spending another 40 minutes following up and hear it a second time. And I kind of mention that partly because there's some themes here that Brent is talking about that we're not going to have time to go into, that we have before. I mean, one of our most popular videos has a thumbnail that says "Hell is coming," and we talk about the Japan yen carry trade. And there's also an earlier video that we reference in that conversation that goes into that topic even further beyond that. So it's important to understand it, because the world is flooded with U.S. debt, but these other nations don't have a printing press to the US dollar. And so when the dollar gets stronger, dollars are more scarce. They still owe or have to pay these debts off in that currency, but in local currencies, they have a lot less purchasing power for the dollar.
That's absolutely right. And again, this is, I hate keep coming back to the dollar milkshake theory, because I feel like people are kind of sick of hearing it. But this is the reason why I came up with this framework, because I had to figure out why what I thought should be happening wasn't happening. And this was a framework that helped me figure that out. And it has helped me, I mean, for the last, 6 or 7 years that it's been going on, I don't have a lot of sleepless nights, because I feel like I'm prepared for anything. It doesn't mean I'm going to get everything right, but it just means that it helps me, not get wiped out by these rogue waves that come along, because I kind of feel like I understand the forces that could cause those to come along. The other thing I would say is I thought I always try to hold myself to account as much as I can, especially if I'm accusing somebody else of being or flawed because of it. And again, the most important thing in my line of work is timing. And so, when these people, it drives me crazy when people have been saying for 20, 30, 40, 50 years the dollar is going to die, and it hasn't, and they just keep saying it. Again, someday they will be right. But then I've had people say, well, Brent, you said the whole dollar was going to go higher a long time ago, and you didn't get the timing right earlier. And you know what I say to that is, you are right. In my business, if you don't get the timing right, you're wrong. I thought when we first started talking about this in 2008, I thought it was a 4 to 5 year time horizon. So I had 2023 to 2024 or something like that. And, so by that, I thought it would have happened by now. I thought we would have already had a currency crisis. I thought we already would have had a sovereign debt crisis. And so I'm happy to hold up my hand and say I got it wrong, because in my business, if you don't get the timing right, you're wrong. Now, will I continue to be wrong? I might continue to be wrong. I don't know. But this is why I have never told anybody to go 100% in on this trade. I've just said you have to be aware of it. And I don't think that you can go by without having either some kind of insurance against it, or an awareness of it, or a plan to deal with it. Because this idea that the dollar is just going to get whittled away over time, and it's gonna lose global reserve currency status, and Bitcoin and gold are going to take over the world, and the U.S. is going to falter and China is going to rise. It's a very popular, very romantic notion, but it's not reality.
Yeah, and on that theme, as we wrap up here, one of the things too, I think, we receive credit from people who watch the show generally about being grounded and objective, and I think that's a huge part of the message in this video, as generally they all are. Some of the negative, and I wouldn't even say negative, but the cynical takes on whether your views are right or the timing is right or wrong, I think are people who are just looking for an excuse for their own underperformance. Generally, it's missing the point of the conversations. They're just picking on one little thing and not listening to everything that we've covered here. But part of managing, a show like this is you're out there seeing other content. And one of the things I notice frequently is on other channels that may be a lot more bearish, histrionic, dramatic. Every piece of content it's the end of the world. The comments feed on that. And so one of the things I would also encourage is look at not only the content you're viewing regularly because it supports your bias, but look at how you're engaging with content that doesn't. And it's very interesting to me to see how people will be rah, rah, rah when someone's making a comment about, the global economy crashing or the US is doomed. But that narrative has been pushed for 30 years, actually, I think since the 70s. So people are hunting for things that reinforce their bias instead of actually, I think, trying to find real alpha or a real edge. And no one knows the future, so we're all fishing for that information. But if you aren't actually looking at it, if you don't actually know that you're looking for that objective edge, you're never going to find it.
That's right. That's right. And so, I encourage you to, listen to different people and follow them and read as much as you can. But, take a score of whether or not they turn out to be right, and again, do the same for us. Do the same with us. And, I'm happy to admit when I'm wrong. I'm happy to, take a little credit when I get things right. And, but that's the way this goes.
Well, Super Bowl weekend, excuse me, it's Super Bowl weekend. You've got a Super Bowl Tuesday. I think probably for us, Brent, what's more important is Super Bowl Tuesday. We're going to have to use that the next 72 hours or so because you got CPI and your debate. Hopefully everybody tunes in for that. We appreciate you tuning in for this episode. Be sure to follow Brent through that debate. I believe they'll be hosting it live. And leading up to that, you can follow him on the X, on the Twitter, whatever it's called these days, at Santiago AU Fund. You can find me at John Kutsmeda. You can find this show both on YouTube and on Twitter with the handle Milkshakes Pod. That'll do it this time. Everyone have a great weekend. Enjoy the Super Bowl, and we'll see you next week. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.